Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. We all know that geopolitical events have an impact on financial markets, but predicting when these geopolitical events will flare up, like the conflict between Israel and Iran, isn't easy, nor is what it actually means for the market. That's what makes the Geopolitical Risk Index so interesting, not just for tracking tension on the global stage, but also for what it tells us about share market reactions. Mousina is the Deputy Chief Economist at AMP. Welcome back to Fear and Greed.
Hey, Sean. Great to be back.
First, the background. How does the Geopolitical Risk Index work?
So it's basically a tally of newspaper/media articles and mentions of anything related to geopolitical risks. So, for example, things related to defense, military, missiles, defense spending, interventions, airstrikes. And what we tend to see is that when there is some sort of geopolitical event, like a missile strike, an invasion of a country, even things like a nuclear disaster, that index will rise on the day and vice versa. So I think of it as like a concurrent indicator of activity. It's not leading, because how can you lead a geopolitical event? It's basically impossible to predict what leaders around the world are going to do when they're going to invade a country. I mean, sometimes we do see markets actually anticipating conflict, and we have seen that in recent weeks with Israel and Iran. It's sort of tensions have been building over the past few weeks. The oil price has been rising a little bit, but we don't know when the actual event will happen. So the index basically just rises and falls as events flare up and flare down.
So in a longer time scheme, so we talked about the last couple of weeks, what's it done in the last couple of years compared to that sort of post-GFC period?
Yeah. So the index has been running since about 1900, or we have data from that point. So we do have quite a long series for it. Basically, after 9/11, we had a 20-year period of quite low geopolitical risks. And I guess that was sort of the so-called peace dividend after the Cold War. And we did see some tensions flaring up and down. For example, the trade war with Trump 1.0. We had Brexit. Those are still some geopolitical events that did see a rise in the index. But since 2021, we have actually seen this continued increase in geopolitical risks. And it sort of feels like that as well, where you're just reading the news, you sort of think, how is all of this happening? It sort of seems a bit overwhelming. But if you think about the tensions in the Middle East, which have been going on now for a few years, the Russia-Ukraine war, the trade war, the China-Taiwan tensions, the Hong Kong protests, of course, COVID. There have been a lot of events occurring in the last few years, which sort of make the global order seem a bit more uncertain. And when I try to make sense of that, I sort of think it makes sense in the environment where you do have a lot more dominant players in the global economy. For example, China is now the largest economy on a purchasing power parity basis, surpassing the US. It accounts for about 19% of world growth on a PPP basis versus the US at 15%. So we've moved into this multipolar world, basically from a unipolar world where the US was the sphere of influence. And when that happens, you normally do tend to see geopolitical risks flare up, because every country has its own agenda. And in particular, in the last years, it has been about tech and the tech race. And that's sort of part of what the trade war between China and the US is trying to solve.
How does that flow onto share markets? Is it possible to look at the data on share markets post these flare-ups and see what markets have done?
It is possible. I mean, it's difficult because you sort of need to figure out a start date and an end date to the conflict. And that is quite hard, and that is very subjective. And analysts try to do that. And that's why you always see different numbers from different analysts about what the actual impact of a conflict is on markets. So what we tried to do was we looked at each event in isolation. We looked at the rise in the Geopolitical Risk Index. We tried to look at the events that had the biggest impact, the Geopolitical Risk Index, and we looked at what else was happening around the time of that event. So, for example, was there a recession? Was there bad data? Was the Fed raising rates? Was the Fed cutting rates? So you need to think about the economic environment more broadly and then figure out what the actual impact of that event was. Events have different timing impacts as well on markets. Some events are quite short-lived, whereas other events, like for example, the First and Second World War, obviously go for a very long period of time, so have much longer impact on markets. What normally tends to happen, though, is markets see this conflict, they tend to fall, then they bounce up, and then the conflict might get worse, and then markets will fall even further. So when we looked at the largest events, really since the First World War, we found that geopolitical events generally impacted markets by about -8% in the short term. But 12 months after that event, markets were usually up by about 14%. So yes, geopolitical events have a negative short-term impact to markets, but generally share markets tend to recover 12 months after the fact because there are other things that are going on and the conflict is perhaps not worked through, but it's not as much of a big deal for share markets.
Staying with me, Deanna. We'll be back in a minute. My guest this morning is Deanna Mousina from AMP. Okay, so I get what you've said. What I suppose the tricky bit for investors is that you can't actually predict these geopolitical spats, for want of a better term. So how do you play the market when you don't have that ability to predict it?
Well, the first thing to keep in mind is that it's good to be diversified, especially if you know that you're in for a period of heightened geopolitical uncertainty. And I think that is a period that we're in right now. It's hard to see the geopolitical environment getting easier or better in the next few years because we are still going to be in this multipolar world. We do still have these trade tensions going on, which means that we are going to see more volatility in markets. Diversification is important. You need to consider if capital growth is more important to you as an investor or income. What is your risk tolerance as well for that volatility? Do you want to have an exposure to gold? Because usually gold does perform quite well in times of geopolitical uncertainty. We used to think of the US dollar, US treasuries as being good safe havens, but I think that narrative has also changed more recently because of what's happening in the US and the US moving more internally and demand for the US dollar going down. So if we know that we're into this period of volatility, diversification is important, but also holding more safe haven types of assets, potentially like gold or the Japanese yen, depends on your risk tolerance as well. And then also knowing that if the share market's fallen after a geopolitical event, don't panic. It's too late to sell out at that time. You basically need to wait for the market to recover, or potentially it's even a good time to get back into the market if that is your risk tolerance. Again, it depends what stage of your life cycle you're at, what type of investor you are. But if the share market's fallen by 5 or 10% after news of a conflict, I wouldn't panic. It obviously doesn't feel good, and it's obviously a big negative for civilians and from a more personal point of view. But from a share market point of view, it's not the right time to sell because we know that eventually markets do recover and over the long term, shares do go up.
Okay, that's a great wrap. I'm wondering, 10 years' time, and the concept that I'm really thinking a lot about here is the idea that we had the US as the global power, and now we have, China on a purchasing power of parity, bigger than the US, the whole safe haven status of the US dollar. I don't know where Europe fits into this, but potentially Europe rises as a real power as well. This is an impossible question, Deanna. I accept that. 10 years' time, though, what's it going to look like? I mean, as an investor and in my time growing up, kind of it's been US, 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 and if you're in doubt, go US. But what you're talking about, that could all change.
So there is a difference, I think, between the investing universe and then the economic universe. So from an investing point of view, I think the next few years, the US is probably still likely to dominate. The US still has some of the best companies around the world. Corporate earnings in those companies are still incredibly strong. Yes, investors are feeling a bit more wary about the US dollar, US treasuries, potential taxation change as well. But at least the next 5 years, I do still think that US equities can have pretty good returns relative to other markets, although the US has actually underperformed relative to Europe and even Australia this year. But over a longer term period, I do think that emerging Asia, emerging markets, China will become more investable. A lot of investors have fled from China in the last few years since COVID, thinking the Chinese share market's too volatile. But over the long term, China could look more investable, emerging markets similar, potentially opportunities in Africa. If Europe gets productivity growth going and gets out of this doldrum of growth that it's been in for the last 10, 15 years, Europe has quite good opportunities as well. And for domestic investors, of course, there's also always that domestic bias because of things like franking credit. So basically, I think that over the long term, we're going to move away from America first dominance in the investing world and in America to be a bit more balanced around the rest of the world.
Deanna, thank you for talking to Fear and Greed.
Thanks, Sean.
That was Deanna Mousina, Deputy Chief Economist at AMP. This is the Fear and Greed Business Interview. Remember, we are not an investing podcast. You should always get your own financial advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed. Business news you can use. I'm Sean Aylmer. Enjoy your day.